Hey, good morning, everyone. Welcome to the Macro Snapshot. We are Monday, March the 16th, 2026. Okay, so let's immediately just look at the oil price because that's obviously what's driving markets at the moment. What we do see here is that oil gapped higher last night, so it gapped up to $102, so gapped up by about $2. But what's interesting is that oil actually it sort of gave back its gains sort of overnight. So the interesting thing is here, why is that? Because we know that in the last 48 hours, the Americans, the Trump administration, basically attacked Kag Island with the sort of oil sort of processing and export hub, but it was only military targets, and specifically, Trump did not target or destroy the sort of oil infrastructure there. And again, he's saying to the Iranians, "Hey, if you don't sort of play ball, that could be a possibility." But really, what seems to be going on also over the weekend, Trump is really sort of putting out feelers, and we can presume that behind the scenes there's negotiations going on for some kind of coalition, of sort of allies to kind of get together a flotilla of ships to sort of support tankers coming through to sort of protect and accompany tankers coming through. So he's also saying that he expects China to be part of that sort of coalition of ships to protect tankers. Otherwise, there's the vague threat that maybe the end of this month's sort of summit meeting with President Xi could be postponed or delayed or cancelled or something like that. I don't think the Chinese will respond publicly to such pressures and will not appreciate that. We also have the Italians saying that they're not interested. So I'm not sure if we'll get this coalition of sort of ships, protective ships convoy. But nonetheless, it does seem as though, in some sense, maybe Trump is looking for a way to get the Strait of Hormuz opened and understands that this is a problem. Having said that, we do have the oil pipeline from Saudi Arabia taking 6 million barrels a day. Um, the Iranians are still sort of sending about 2 million barrels a day. And then also in recent developments over the weekend, it now seems that Iran has basically said that ships going to India would be sort of allowed free passage and possibly even to China. So suddenly, if we start getting sort of ships to sort of China, India, we've got the Saudi Arabian East-West pipeline. We're still getting some oil out from the Iranians. The situation is maybe not as bad, although it's still sort of critical. And every day which passes, of course, is causing more and more disruption. But it does seem as though maybe the market, I'm just trying to sort of figure out why the market here is coming down. Maybe the market is sort of seeing an end game here, that in some shape or form, the Strait of Hormuz will be open, forced to open, maybe because of political sort of economic leverage on the Iranians. Or maybe just because the ships come in. So that's interesting. Or maybe it's just simply that the market has decided that the risk premium, this is when the war happened, we were at about $69, $70. That's about $30. So, it's almost 40, 50% increase. So maybe the market is saying that for the moment, that reflects the risk premium. So not necessarily expecting this to collapse in any shape or form, but maybe we'll start trading in a range now between, who knows, maybe like 92 up to $100, something like that. And of course, we have to keep an eye on all of the sort of political developments. The other thing which I'm sort of interested in is that there's a sort of a fleet, another fleet sort of steaming from Japan with Marines on board. And who knows, is there's going to be some kind of land invasion to take that sort of Kag Island oil processing sort of hub, and maybe sort of put the pressure on the Iranians that way. We'll see if that happens in the next week or two. But so far, there's no sort of off-ramp. It seems as though there's still military actions happening both from the Israelis and the Americans in Lebanon and obviously in Iran. It seems that Iran, their navy seems destroyed, their air force seems to be destroyed, and their missile sort of ability to fire missiles seems to be severely compromised. But having said that, in order for them to sort of harass the Strait of Hormuz and keep it effectively sort of closed to traffic it doesn't like. All they need is a few sort of drones here and there, some fast speedboats clamping limpet mines on ships. So Trump knows that. So it's an interesting situation here, but just at the moment the market taking a little bit of a pause. So I just want to show a few charts, just get a bit of an overview, just at the beginning of the week here, and see what's going on. So my Zoom's changed, of course. Mamma mia, it always changes. Why has it changed? Let's have a look here. So let's just see. One of the big things happening this week is we have a lot of central banks. So as you can see here from the map, we have central bank decisions from the Fed, Canada, Brazil, Australia, which is going to be this evening, the ECB, Bank of England, Switzerland, and others. So a lot of central banks, so it's going to be very interesting to see whether there's any hikes which are sort of occurring, and just what the reaction is going to be to the situation in Iran, especially comments on inflation. We're also starting to see a little bit of divergence here. If you look at three of some of the biggest central banks here, you see something like the Fed. This is what the market is implying for the sort of the path of rates over 2026. And you can see here the sort of orange line. You see the Fed, the market is still pricing in, maybe one cut. It's been a lot hawkishly repriced, but still, what I'm trying to point out here is that then you've got the Bank of England primed for potentially, maybe one hike, and then the ECB, the market is pricing in a sort of over, almost up to two hikes. So the point is here, we're now starting to get this theme of divergence, and that's going to be interesting to see how that plays out in the currency markets. In terms of this evening, we have the RBA decision. Now, the Australian economy is doing relatively well. They have quite high inflation. They have low unemployment. There's definitely concerns there about inflation. And just reading some commentary over the weekend, it does seem the market is pricing in a hike. The market is pricing in a hike for this evening, and maybe even another one. So if you look at the future path of what the market is pricing in sort of over the next sort of year, you can see the market is pricing in another sort of two or three hikes. So that's caused the Aussie to do pretty well. In terms of some other stuff I want to keep an eye out for, just keep an eye on oil. Let's look at a couple of oil charts here. This is a cute graphic, but what I'm trying to say is that we're always sort of, just sort of talking about oil, but the reality is that there are different winners and different losers. There are different grades of oil. You've got the light sweet, the medium sour, the heavy sour, the extra heavy. So, for example, which Canada and Venezuela sort of produce. And then if you look actually over in the Middle East, they're more, it's sort of here, the heavy sours. So that's very, very important for China and India, and also for sort of South Korea and for Japan. So just keep in mind that the grade of fuel which is most affected at the moment is kind of in that sort of medium to heavy sort of sour. That's really what's produced in the Mid East, and really the most affected markets here as Asia, and that's why we see the Asian sort of equity markets under a lot of pressure, and probably they're the countries which are most sort of in need of the Strait of Hormuz to be opened, which is, not so much the situation, let's say, for the US sort of consumption or production. Okay, just keeping on the theme of oil, and just also you could see really just in terms of some of the subcomponents, so to speak here, if we look at sort of the benchmark fuel oil of Singapore, that's you can see here just how high that's gone, even higher than when Russia invaded Ukraine, and even going back to that, as they call it, the commodity super cycle, around about 2007, 2008. So we've seen that jet fuel has exploded in price, diesel, all of these things have exploded in price. That's obviously putting a lot of pressure on airlines, especially and airline routes, the airfares from, let's say, Australia and Asia to Europe. That mainly transits through the Middle East, like Doha and Dubai, these kind of places. So we've seen that those airfares have exploded, and it's putting a lot of pressure on the airlines as well. So that's something also to keep in mind. Other things to keep in mind here is just going to, in terms of oil, just want to keep an eye on oil. We're also just seeing here, just looking at some of the spreads. So if you just look at the different prices of the contracts, you can see here the curve very much still in a very steep backwardation, but it's kind of telling us a couple of things. What is obviously we have a very, very steep backwardation. So you see here the front of the curve, and even if you look at the prices we're about to roll over into the May contract from officially from this Wednesday. So if you look at, let's say it's like April, May contracts, you see that they're in the 90s. And you see the sort of the change is the up plus $5-6. This is snapped on Friday afternoon. But then you can see for the further out we go, June, July, August, September, October, you can see here where there's almost like sort of a $20 difference here. So you can see, let's say the front contracts here in the 90s, but whereas if you go out to, let's say, November, December, or even out to next year, you can see a $20 difference. So very, very steep backwardation. But what's interesting is that what is that telling us? That's obviously telling us that the market is stressed in terms of near-term deliveries, but it's also expecting that the Strait of Hormuz and the general situation will moderate at some point, and that there's no need for the back of the curve. So let's say, let's say 6 months or so to actually sort of rise that much as well. So it's interesting, kind of contradictory things, saying, yes, there's a problem now, but no, we don't think that this problem's going to last for 6 months. And we see that a little bit if we if we look at the curve, we've just got one of the curves here. We've got from the 3 months to the 6 months. So that's oil delivered 3 months from now until 6 months to now, and you can see that that is under a lot of pressure, that 3 month one. So you can see here, just by way of comparison, you see the sort of the spot prices here, 88 versus 79. And again, this is not the prompt. This is 3 months from now. So what I'm trying to say is that it's still a huge backwardation for that. But the back end of the curve is still not reacting that much. But just to put that in context, just where we are historically, if you look at that the 3 to 6 month sort of spread, and if we go back to the Russian invasion of Ukraine back in 2022, you can see that that was like a $4, $5, $6 differential, and at the moment we're at a sort of $8, $9, $10 differential. So for sure, there's a massive backwardation happening, but the market is expecting this situation to calm down in a month or two. And really, what's going to cause I think of another further hike in prices higher will be if the market perceives that there is no resolution on the horizon and that we're going to have structurally high oil prices maybe throughout 2026. Now, if we get that, that means that the back of the curve will start moving up as well as the front of the curve in oil, and the market at that point will probably start to price in a sort of consumption destruction and maybe even a recession, because at that point, if we have extended elevated oil prices, we have to think that some kind of slowdown in global economic activity could occur, and indeed maybe not inflation, but even deflation as we start to get into recession. Okay, so just looking at a few other things, I've got a bunch of other charts here. It's just interesting to see also who the winners and the losers are and who is perceived by the market to be the most affected. And keep this in mind as you trade this week. So here, just looking at the 3 month short-term contracts like the SOFRs in the US, but also in other countries. You can see here that if you look in this sort of blue and orange here, this is for the blue is for Europe, so the Euribors, and you can just see how much they've come down in price and therefore up in implied yields. And also, if you look at the orange, that's for the UK, so the SONIA. So you can see here that the market is basically saying that the inflation prices and the hawkish repricing really is being concentrated. I mean, it's happening everywhere, but really sort of in the UK and in Europe are the sort of zones and countries which are perceived to be most affected by higher energy prices, higher inflationary pressures, compared to, let's say, the US here and Canada in the white and this sort of a lilac, respectively, which also have gone down in price, but not nearly as much as in Europe. So then if we can continue, you can also see here in the inflation swap. So again, similar kind of situation. You can see that inflation swap in the US, which is the orange, that has gone up. But really, again, looking in the blue and the white lines here, which is the blue is Europe and the white is the UK, you can see just how much the inflation swaps have pushed much higher as well. We looked at the oil, and also just looking at oil, getting back to the US. Sorry, just jumping around here. I've got a bunch of different charts. Just keep in mind the political pressures on Trump and the Republicans for the midterm elections. Just look here at the average gasoline prices. So you can see here just how they're spiking up, and you can see the 14-day change, both in dollar terms, has gone up a lot, and also in percentage terms. You can see just how much that's gone up. And this chart here also gives you a little bit of perspective. We're basically at levels in terms of the dollar change and the percentage change, which is the same as when Russia invaded Ukraine. We're also seeing in diesel. So again, getting back to that concept of jet fuel, diesel, and sort of transport fuels, prices, all of that has going up. You can see here in diesel price, the similar kind of situation here, just how much that's going up. And if that stays like that, that's going to cause a lot of domestic political pain for Trump. So Trump definitely, I think what he's trying to do is to say, hey, the midterm elections are in November. We're now in the middle of March. I just have to tough this out, try and get some kind of victory, destroy Iran and the threat, and sort of, call it a day. And maybe he's saying he could deal with this pain for another 2 or 3 or 4 weeks with his elevated diesel and gasoline prices. But then I suppose he's hoping that they will sort of come down and that will alleviate the political pain. But just getting back to the macro here as well, looking at the break-evens and this sort of theme of inflation, which we're going to look at a lot this week with all the central banks. You can see here the break-evens, which is what the market is imputing for basically the difference between sort of nominal yields and the real yields here. You can see the break-even is inflation expectations here. You can see on the 1 year, oh, sorry, the 2 year, which is the white one, you see how much that's pushed up. And then if you look at the 5 year, it's also pushing up. Not so much longer term, the 10s, 20, and 30s down here remained, a little bit more elevated, but essentially relatively flat. So you see, it's really the 2s and the 5 year break evens which have gone up. So that's inflation expectations. And the Fed and other global central banks definitely won't be enjoying this. Just in terms of the US, we can see here the effective Fed funds rate. I can see in the blue here, this pale blue, the Fed, has cut and they held and they've cut a little bit more and they're sort of holding just at the moment. Are they going to cut more? We don't know. But what I'm interested to look at here, the white line here is the 2 year yield. And you can see that that's now actually just above the effective Fed funds rate, which is pretty unusual. You can see that normally it's above. So just from a trading perspective here, you can see, they're essentially the same here. And we're expecting, excuse me, the Fed, maybe to be holding or potentially cutting once this year. That's what the market's saying. That's telling me that the 2 year yield probably doesn't have too much more to rise. It's risen quite a lot as we've been looking at the charts over the last week. So that's an interesting one here. I think any sense that this sort of conflict gets solved, or that the Strait of Hormuz gets opened, or indeed that the US economy starts to slow down a bit, we can see these 2 year yields coming down. And I think a long ZT kind of trade, or even the SOFRs, personally looking at a 97 to 98 call spread on the December 2026 SOFRs, that's definitely going to react quite strongly. And just talking about the SOFRs here, again, I've been showing this chart a little bit, excuse me, throughout the week, but you can just see here, compared to just the close of trade on Friday, you can see on Monday here, sorry, on Friday, and then you can see compared to, let's say, sort of a month ago or so, you can just see how much, how hawkishly the market has repriced, sort of 15, 20, 30 basis points here. And you see the terminal rate has risen a lot. So quite a lot of hawkish repricing here. And then you say, well, okay, is this causing stress on credit? So I thought it'd be interesting to look at just where we are with credit, because there's been a lot of talk about sort of private credit and whatnot. And what we're seeing here is that there is a little bit of pressure on credit. If we look at the high yields, so what we've got here is the investment grade. So the investment grade here is the white one. You can see in the US, it is moving up a little bit higher, but still at pretty reasonable levels. We're not getting to any kind of crisis levels, which we saw with sort of the banking crisis and everything. So the investment grade is definitely creeping up, but nothing too nasty. Whereas we are seeing with the high yield, which is this sort of a yellow orange line, we're seeing that high yield sort of the credit spreads are going up a little bit more. So that's definitely something to sort of keep an eye on. And let's just see if that continues to move higher, because that will gradually put pressure on especially the lower quality companies. So that's interesting. I just wanted to have a look at all that stuff. If we just then go back to the charts, what we have today, a couple of interesting things. Oh my God, the Zoom, why do they keep on changing? Engineers must get bored. What we're seeing today is, well, we have NVIDIA's CEO, sort of Jensen Huang, is going to give some comments. So apart from the whole Iran thing, it's going to be quite interesting to see his take on sort of, sort of demand for sort of chips and AI and everything. So keep an eye on that. We also have Canadian CPI. And keep in mind, we had horrible numbers coming out of Canada for employment last Friday. I think it was minus 95, or was it minus 65? Anyway, horrible numbers. So that's going to put pressure on the Canadian on the Bank of Canada. But we have the Canadian CPI today. Let's keep an eye on that. What I want to also just look at is the chart. A bit of risk on this morning. I don't know if we could call it risk on, but definitely a pause, and everything is generally a bit more positive this morning. So we're seeing the equities had a little bit of a bounce from this sort of low. If we look at the NASDAQ, similar kind of situation. The US is still outperforming Europe. And in general, global equity just at the moment, because as we saw, a lot of these sort of geographic destinations like Europe, the UK, and sort of Asia in general are energy importers. So they're sort of underperforming the US stock market. So we're seeing the Euro stocks, not nearly as good a recovery as the US. If we look at the DAX over in Germany, also off lows, but still pretty weak. If we look at the Nikkei, up a little bit, but again, trading heavily. If we look at Brazil, which is an energy exporter, But the problem here is that a lot of money flows have come out of emerging markets. There's sort of inflationary concerns. So in general, the emerging market space has been hit. So Brazil under pressure. We see India is under a lot of pressure because they are an energy, not only a sort of emerging markets or developing markets, but also an energy importer. So they've been hit very, very, very hard. If we look in the emerging market space in general, EEM up a little bit in the pre-market, but still trading heavily. So these themes, we have seen a little bit of recovery this morning, but overall, the themes of US outperforming non-US equities is still there. Emerging markets underperforming developed markets is still there. Now the dollar is up, is down a little bit. If we look at the dollar, you can see the dollar down about 40 basis points off that very key level. It basically came back in. So most currencies up a little bit, but again, we'll see if this is a trend or just a little bit of a reaction, a bit of an overreaction and stuff. So we see the euro up a little bit. We can see the yen up, well, a tiny bit, but again, not much compared to other currencies. We see the Australian dollar. Now, the Australian dollars and the New Zealand dollars are outperforming. You see the Kiwi doing pretty well and bouncing. The Aussie dollar also bouncing over 1%. And that's, as I say, because we're expecting the RBA to hike this evening. And of course, with the RBA, it's going to be interesting to see the future paths and what the governor, Michelle Bullock, says. Having said that, it may not be unanimous. There may be one or two votes against, so some kind of dissension, because there are some concerns that the global economy may slow down despite the inflationary pressures. So that's going to be quite an interesting one. And as I said, we have the Bank of Canada, the Fed, BOE, ECB, everything later in the week. So we have a lot going on. So, but you can definitely see today, I don't know if you want to call it a risk-on sentiment, but definitely a little bit more of a positivity in the market. But I think it's more of a lull, just waiting to see what happens with the geopolitics. Oil, we see oil just not doing anything horrible, just sort of flat. If we look at spot silver, we can see that silver down. If we look at the just on the futures chart, you can see here just bouncing off that Fibonacci level, which is basically this sort of fib here, the 61.8. So just taking a little bit of a pause. Copper going sideways. What is interesting, the BTC, as I was signaling, a pretty key element. It is showing some quite positive price action here. So we're getting that little sort of fib here was bought more or less around the 66,000 zone, and we're now up to the critical level. This is where we were rejected before at the longer term fib. So you can see this longer term fib. We were rejected before at that also horizontal resistance at about 74,500, 75,000. We were rejected a second time. This is critical because really what the bulls have to do here, this is now 3 times. They need to, push higher and say, hey, we've had enough of being down in the 60s. We want to push up into the 70s and the 80s. So watch that level. I'd say it's very, very critical levels, essentially 74,000, between 74 and $75,000 here. But BTC doing okay, and definitely the price action is looking supportive here. Okay, guys. Excuse me. I'm going to leave it there for today. Obviously, we have to keep an eye out on headlines, see if there's any sort of situation here with China reaction. I'm curious to see if China reacts to Trump's comments about the delaying the summit between President Xi and Trump. I think the Chinese will not at all appreciate that kind of public sort of browbeating. And it's also going to be interesting to see if any of the so-called allied nations join with the US to try and get together a coalition of ships to kind of sort of force open the Strait of Hormuz, or to accompany tankers through there. If that's the case, we could get a substantial risk-on rally if we get those kind of headlines. So let's keep on looking out for those today. Okay, thanks very much. I'm going to leave it there. Have a great day, and I'll be back tomorrow with the macro snapshot. Thank you.